This past month, a member of the Unrivaled Investing community asked me about Fortinet stock, FTNT. So when I saw that it dropped following their latest earnings, dropping around 13%, it got my interest. I want to learn more. When I look at their history, wow, strong historic revenue growth, strong historic profit margins. I mean, this company is in a league of its own. You look at their historical returns, not only from a financial perspective, but from a stock return perspective, you see this has done over a 10x in the last 10 years. And I like to remind investors that if you're looking for, let's say, a 100 bagger or looking for a stock that can go up 10x, why not find something that has already executed? For that 100 bagger, look for something that's already done 10x. For a 10x, look for something that's already gone up, 100%. And that there might be something there to it. There might be underlying fundamentals. And that's clearly the case here as we look at Fortinet. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. I like what I see here. I like, what I'm in terms of learning about Fortinet. You're talking about a company that's one of the largest cybersecurity players out there, offering one of the lowest cost of ownership in the industry for what they offer. Cybersecurity is a huge and growing industry. They estimate that their addressable market is over $190 billion, so a long runway of growth. When you look at their products and revenue, they break it down really into three different silos: secure networking, around 70% of their billings; security operations, around 10%; and universal SASE, which stands for Secure Access Service Edge. That's around 20%. The way to understand all this is that Fortinet's value proposition is to offer a comprehensive integrated suite of secure networking and cybersecurity solutions. So that includes the Secure Access Service Edge, which enables employee remote access to be able to access, secure company files anywhere and in a safe environment so it doesn't get compromised. So when I'm looking at this, one of their key products is an enterprise firewall. It looks like they're one of the top players along with Palo Alto Networks, but it is worth calling out that it's not like they're the only player. There's a lot of different players here that operate and compete in the arena, looking at the different competitors. But management makes a point of, at least based historically, that they were one of the number one from a revenue market share perspective, and they were comparing their size and growth rate to Palo Alto Networks and saying, yeah, when we also grow a lot faster than Cisco and Checkpoint. So saying, yeah, we are one of the top dogs and we're growing faster than others. And by the way, we're better managed because our stock-based compensation is much less, so you're getting less dilution, and our profit margins are much better, than the industry average and Palo Alto Networks. So they're calling out, hey, we think we're doing well, both on growth and profit margins. I look at their free cash flow. I mean, this is fantastic. Over $2 billion in free cash flow. There's a lot to the story here that I really like. And so then it becomes the question is, well, why did Fortinet even drop in the first place? So what's going on here? So I check in with AI Ticker Chat, which leverages artificial intelligence, to answer this question. So I'm pulling up the latest earnings call and I'm asking, why might the stock be down on these results? Why would it go down? It calls out a couple of different things. First of all, it mentions how secure networking growth, which is a significant part of their business, reported a slowdown, might indicate a decrease in demand for their products, potentially increased competition. So I'm going to want to learn more about some of these other companies like Palo Alto Network. Is someone starting to eat their lunch? They talk about reported challenges in sales execution and marketing inefficiency, longer sales cycle, and increased deal scrutiny. So these two things suggest, a tougher environment for them to grow. They also talk about how service providers and retail sectors were particularly weak. That may have contributed to the decline. So it's really getting down to that key issue of this uncertainty about the company's future growth prospects. I mean, they did mention this retail sector, service providers. You see that retail's around 10% of their customers. Retail, another way to possibly look at it is the size of the company. And you see that, small enterprises are around a quarter of their business, but they do have a lot of, mid-sized enterprises. So small and mid is about half. Then the rest is these, large enterprises, businesses. Looking, diving into their actual results, you see that, yes, revenue did slow down from, let's say, 25% to only 16% year-over-year growth, in part because product sales declined slightly. Services were very strong at 28% growth, but billings, which is a leading indicator, effectively the cash that comes in, that actually was really weak at only around 6% growth. So really significant slowdown to the point where management's saying, yeah, in the next quarter, we actually expect a 5% decline in billings year over year, only 10% growth. And so, maybe their growth accelerates in the years ahead. This is something management calls out. So the question is, well, where does Fortinet stock go from here? Now, first of all, in full disclosure, this is not financial advice, and also a quick plug at Unrivaled Investing. My goal is to help everyday investors by identifying companies with compelling long-term business prospects, attractive valuations, and aligned management teams. I'm looking for companies that I can partner with and hold for years with the prospect of hundreds of % upside. I share my investment journey in a weekly letter at unrivaledinvesting.com if you'd like to learn more. There's also educational materials if you want to learn how to read financial statements or learn how to value stocks there as well. So one of the first things that I love to find with my companies and all my investments, I prefer, it's a very solid preference that there's alignment with management, usually in the form of significant stock ownership. I prefer it actually if they're one of the largest shareholders. And that's what I see here with Fortinet. I see that these two brothers that have top executive positions in the company, they own around 20% of the company. So no matter what happens from here, they've been with the company for a long time. And no matter what happens to the stock, they're going to be impacted as well because they combined own 20% of the stock. So I like to see that alignment, that ownership. I'm mindful, and this is something from their slides, that they might be spending that $2 billion in annual free cash flow on acquisitions. Because whenever a company calls out a highly fragmented industry ready for consolidation, they're effectively saying, look, people are going to be merging, people are going to be acquiring each other, and arguably they're going to be in a fine position to do so, given that $2 billion in free cash flow. So then the next question is, okay, so management's aligned. What's their track record on intelligent capital allocation? Because historically, M&A was a very small piece of this business. They've done more in terms of share buybacks over several years. So will they do an intelligent purchase? Will they not overpay for a potential acquisition using that free cash flow? Because that can be a great source of future returns. If you take that cash flow and let's say you use it for growth, you use it for making a acquisition that really accelerates your business or fills in certain spots in your business in terms of your lineup. When I check in with AI Ticker Chat, based on their historical results, this doesn't quite yet include their third quarter results. It's saying, look, there might be somewhere between 50 and 100% plus upside. I'm largely aligned with this framework. It might be a little bit more bullish, but let's just do a super high level thinking about this. So this is a business doing, once again, over $2 billion in free cash flow. And at $50 a share, you're talking about a company with a $40 billion market cap. So $2 billion of free cash flow, $40 billion market cap. That's around a 5% shareholder yield. So then the next question is, okay, so you get a 5% shareholder yield, assuming they could return that to you as a dividend. They could return that to you via buyback. But that 5%, unless the business really starts contracting, which doesn't quite look like. I mean, you're talking about being one of the leaders in the space, growing. So you're talking about 5%. That probably is going to be stable. 1 year they might use it for buying a company, but let's assume that it goes to you. So that's 5%. Okay, that they maybe reduce the pie out, each year, reducing the shares outstanding. So then what's the growth? So this is where it would be super helpful if you have some sort of familiarity with the cybersecurity industry, or if you've used their products or used competitor products. I'd absolutely love to hear it in the comments below. I'm definitely going to bring it up in our exclusive Discord at Unrivaled Investing, just because I want to learn more about this. When I think about this, from a competitive dynamics, I think cybersecurity isn't going anywhere, but one company's value proposition could face challenges from other competitors. So I want to learn more about the competitive environment before pulling the trigger. But this is smelling right, because you start with that 5% yield, then factor in growth. And if you're thinking 5-10% growth going forward, maybe on the low side, then you're talking about the 5% yield plus 5% growth, you're talking about 10% return, maybe 15% return if you're talking about 10% growth. Okay, so this is looking interesting. Then any change in valuation. And right now, so once again, do you think it's going to get, do you think that 5% yield should be a 7% yield? Do you think that, in other words, that valuation, the price should keep dropping? And so that comes down to, do you think that growth is going to stick in there? So I look at this and I find this to be very interesting. The combination of a net cash balance sheet, strong historic returns, strong free cash flow, a leadership position. So management's aligned, it would seem like. So there's a lot more that I personally want to learn here, because this smells like a company that's worth diving further into. And regular viewers know I've covered a lot of stocks on this channel. Most of the time I'm grabbing my nose and saying, nope, this smells terrible. Like, I don't want to dive further in. During the SPAC craze, I was like, not for the most part. I was, thumbs down on most of it, saying it was bananas. This is the type of situation, and we're starting to get into a situation with the market where you're seeing more and more setups like this, cash rich, reasonable valuation. The question is that growth trajectory, because arguably if you think that this is going to go back to, let's say, 10% plus growth in the years ahead, then you're looking at something that arguably is very interesting. So if this video has been helpful for you, I think I'm definitely going to consider learning more about this in maybe a future weekly letter at unrivaledinvesting.com. But I'd love to learn more from the experts out there that know a lot more about cybersecurity. So thank you so much for tuning in and watching Unrivaled Investing. I appreciate that thumbs up, hit that subscribe button. Thanks so much.